Welcome to Assay TV, Ronnie. Thanks for taking time. I'd like to introduce you. It's Ronnie Stöferle, who's a fund manager and head of research at Incrementum AG. How do you do, Ronnie? How are you today?
Thank you very much, Adam. It's a great pleasure being here. I really enjoy this conference, and thanks for having me.
Yeah, welcome. Why don't we start though, given it's your first time speaking in this conference, to introduce yourself, your background, and also talk about Incrementum as well.
Sure. Well, my name is Ronald Stöferle. I'm managing partner at Incrementum. We did set up the company based in Liechtenstein 9 years ago. And we do basically 3 different things. Wealth management for high net worth individuals, primarily from the German-speaking area. Then we do fund management. We've got 6 different funds. Most of them, I would say, are focused on the commodities and precious metal side. I'm managing an inflation protection fund. And then we're publishing the In Gold We Trust report that I started 15 years ago. And this is, the report now. It's quite a brick. Yeah, it's an annual report that I'm putting together with my team, roughly 20 people. And it's really a holistic overview about what's going on in the gold world. So actually, every year we try to write a little bit less, and we fail because there's just so much going on, in the when it comes to the macro picture, but also the political developments. Talking about the mining space, inflation, obviously, what gold does to your portfolio in different environments, and this is what. We are doing for quite a while now, and we're publishing in English, German, Mandarin, and in Spanish, right, and had roughly 2 million readers for the last edition. So it's really a big thing. But this is what most people know us for. But primarily, we're asset managers.
Yep, excellent. Really interesting and very all-encompassing within the gold space. So why don't we delve into some of these trends and things that we are seeing? We spoke yesterday on a panel, and you did an excellent presentation about the world being out of balance, and perhaps that frames some of your macro outlook. But why don't you tell us about how you see the macro picture and relating that back to gold?
Well, the leitmotif of this year's keynote was Koyaanisqatsi, which is actually a movie from 1982 with a terrific soundtrack by Philip Glass. And I watched this movie and I thought, well, Koyaanisqatsi is in the Hopi language. It means life out of balance. And I thought, well, actually, we're seeing so many different parts of markets and of our lives being out of balance. It's of course the society, it's politics, it's when it comes to markets, it's currency markets, it's bond markets, it's equity markets, it's also the gold market. So this was kind of the idea behind. And well, actually, I said that one of the main reasons why markets are out of balance is obviously this inflation shock that we saw, that central bankers did not really see coming. I mean, they told us that it was only transitory, and then very, very late, they had to react with a rates shock. So actually, within the last 8 months, we saw the Federal Reserve hiking rates by 375 basis points, which is an enormous move on the rates front. And therefore, of course, we saw massive consequences for global bond, equity, and now also real estate markets. So just to give you some numbers, world bond markets are facing the worst year since 1865. So it's not only on the bond side, obviously also on the equity side. So for a balanced portfolio, it is the worst year since 1928. So this is already quite telling how historic this year is. And many people have been disappointed with the performance of gold this year. To be honest, I'm also slightly disappointed, but I think there's good reasons why gold didn't really take off. First of all, it is obviously opportunity costs rising significantly. You can basically get from 10-year treasuries roughly 4% now. Then we saw this enormous strength of the US dollar. So this the dollar is definitely like a big wrecking ball for financial markets, and for investors here in the UK, actually gold did a pretty good job. So gold made plenty of new all-time highs in British pound terms. The same for euro investors, the same for Japanese yen, and basically all other currencies, but not in US dollar terms. Yeah. So this is one thing, and then I think we should not forget that within this big thunderstorm, tornado, however you want to call it, many investors are facing redemptions. Fund managers basically have to sell what's kind of liquid, and gold is extremely liquid with 140 billion traded a day. So I think this puts some pressure on the gold price, obviously, and that was basically the core part of my presentation. Now I think we are moving into an environment where actually people will think and talk about inflation less and less, because a recession is basically around the corner. And this is also the case why I am pretty confident that the pivot that everybody is anxiously awaiting, that the pivot will happen rather sooner than later.
Yep, right. And what are some of the economic pressures that this recession's obviously low growth, but are we going to see the dollar weaken potentially and sort of normalize against its currency swaps, and these things will help the gold trajectory next year, perhaps?
Well, I think central bankers still keep telling us that it's going to be a soft landing, a mild recession, yeah, and however they want to phrase it. I just don't buy into this narrative. I don't buy into the narrative. I think I said yesterday at the podium discussion that Jay Powell might be nominated for the Academy Awards for Best Actor, because the whole market believes that actually.
But why does everyone consistently believe the central bankers if there's so much criticism we always hear about them?
Yeah. I don't know. I have to say, I know how large, very bureaucratic organizations work. And they're just always too late. They're always behind the curve. And if you just have a very sober look at the track record of central bank forecasts, I would say they don't have the best track record. Yeah. So I just wonder why people now think, well, Jay Powell is the new Paul Volcker. They are really hawkish now. Yeah. I just don't see that. And from my point of view, I showed a couple of charts. For example, the ISM. When the ISM goes below 50, in the past, the Federal Reserve always lowered interest rates. Then we're seeing the top 10 leading indicators below zero, which has a perfect track record for forecasting recessions. 5 out of 5, the last 5 recessions were caught by this indicator. And then, most importantly, we're seeing the yield curve now being inverted all over. And the yield curve, as many people know, is probably the most reliable indicator for a recession. So therefore, I think it's actually our base case to forecast a recession, which from my point of view for the US will be probably less bad than over here in Europe. And this is also the reason why I think that actually this pivot might happen. So the Federal Reserve will, first of all, recessions are disinflationary, so this will give them much more leeway to actually step on the brakes and make the U-turn. Then on the other hand, I think there will be enormous pressure from politicians, because inflation rates will come down, but unemployment will go up, and the recession will be the central topic next year. And then I think they will put a tremendous amount of pressure on the Federal Reserve to become more dovish. So this is for gold, I think, a pretty interesting setup, especially as the majority of the market is still really buying into this hawkish narrative. And I think when the whole market is on one side of the boat and it just slowly moves to the other side, I think this will have a pretty big impact on the price of gold.
Yep, absolutely. You mentioned the recessionary pressures on Europe and the US, but what about Asia? What about China? And how does that fit in within the dynamic?
Well, when it comes to China, I think that it seems that they now really slowly want to open up. So there's the Fed pivot, and then there's also the Xi pivot.
Yes.
Yeah, and I think if China is really opening up, that would be a very very large positive impact on capital markets. And we should not forget, Adam. You know, commodity prices are down, I think, 22% from their all-time highs, in an environment where actually the Federal Reserve and central banks all over are aggressively hiking interest rates. Yeah? In an environment where the US dollar is going through the roof, in an environment where recession is on the horizon, and where China is basically for more than 2 years locked down. So I think, given those circumstances, I think the commodity space has done tremendously well. And this shows, I would say, the internal strength of the commodity market and the bullish case for commodities at the moment. So I think, if China really opens up, I think this will be one of the largest topics next year.
Yep. Excellent. Very interesting. Okay, well, let's move into more of the commodity space and sort of how you advise on either your funds or your wealth preservation strategies as well. Commodities tend to be attractive as an alternative investment strategy, but also gold and precious metals as a hedge. Can you talk about how you advise on investing into those asset classes, but also link in the mining equities as well, where they sit within a sort of a portfolio construction at this difficult period?
So, I mean, we're managing a couple of funds in this space. So, for example, we've got a uranium fund, right. Yeah, which 2 years ago we almost had to close down. Yeah, and now, people, there's a much more of a sober discussion about nuclear energy, and I think, if we take a step back, I think that 2022 is the year when actually people realized we need the stuff. Yeah, yes. Commodities aren't something negative, something bad. Actually, we need a stable and safe access to commodities. Yeah, and we're now seeing this year that actually, as I've said, 1 or 2 years ago, nobody would have said, well, we like nuclear power, we like uranium as an investment. Now it has changed. So this is definitely a very, very positive development. In my fund that I'm managing, the Inflation Protection Fund, we do not manage it based on a long-only approach. So we're very active, and this is basically our view is that volatile asset classes like commodities, like mining stocks, yeah, have to be timed pretty well. So it's very much of a top-down decision. So actually, we manage it based on our incrementum inflation signal that is basically telling us rising, falling, or neutral inflation. So that means play offense, play defense, or stay on the sideline. And actually, in spring this year, the inflation signal reversed to falling inflation. And we have said, well, actually, it's tough because everybody is so excited about inflation and commodities are doing so well. So we basically put in stop limits. Yeah, we hedged our positions and basically didn't have a large drawdown because it was a brutal couple of months for the commodity space and for the mining space. So now actually the inflation signal has moved to neutral. And I could see that it will rise to a rising inflation signal pretty soon. So now we hold I think roughly 40% in the mining space. We're seeing extremely attractive valuations. I think 100 one-on-ones in the second half of this year, met lots of mining companies. And I think, we're just seeing some, as Schumpeter would have said, creative destruction. We're seeing that, the rubbish projects will be weeded out. They will go bankrupt. But I think that's, that's how markets work. Yeah. So actually, I can see tremendous opportunities at fantastic valuations. We know Buffett said basically at the lows of the equity bull market in the 1970s, he feels like a little kid in a candy store. and that's a very similar feeling that I have at the moment in the mining space. Yeah, so good management teams, great projects at very, very reasonable prices.
What sort of tiers as well do you look sort of earlier stage? Obviously, there's a resource replacement challenge across the precious metals space that might make some of the earlier stage more attractive if it's a great deposit or discovery. Equally, that risk capital for earlier stage hasn't been there for a while.
Well, in the funds that we manage, we have to be very, very cautious when it comes to liquidity. So many of the juniors aren't. We're just not allowed to buy into them because they're just not liquid enough. Yeah? But still, I think you don't have to take really too much risk in a super small caps. Yeah, you can get a very, very attractive risk reward in the producer space and also in the development space. I think that actually in the development space with rising inflation for basically all the stuff that you need to build a mine, then of course higher costs of capital and less risk appetite. That's kind of the triple whammy for many developers, and I'm not sure why the large caps haven't really done more on the M&A side yet. I think they're all very, very actively screening and having discussions. So I expect more activity on the M&A side.
Yeah. Do you think shareholders are sort of putting the brakes on there, saying, "Look what happened before. Actually we're enjoying the dividends or the good cash flow. If you're producing, let's not go crazy on M&A." Yet.
Yes, but we have seen that the premiums that were paid in recent deals were actually quite reasonable, yeah. And most of the time, because back in the days you saw like the acquiring company got sold off big time, and we haven't seen that in the previous deals. However, I think that M&A should never be like the prime reason for buying into a sector. Yeah, I think it's always a little bit irritating when people say, "Well, I'm buying mining stocks because there's so much M&A coming up." I think we're really seeing pristine balance sheets. Yeah, for most of the companies, we're seeing very, very attractive dividend yields. We're seeing decent margins, and I think that the mining executives really have learned their lessons. That doesn't mean that they won't screw it up in the next bull market. Some of them, but I think at these levels, it's a very, very attractive setup. And as I've said, I'm pretty confident regarding gold. It should be one of the main beneficiaries from the pivot that is around the corner. Then I'm seeing attractive valuations. I'm seeing a sector where actually, there's no interest at all from the generalists. I'm seeing at gold mining conferences that even the gold community is really bearish, and I think this is already quite telling. Yeah, so I think it's a pretty good setup.
Yep, absolutely excellent. Okay, so if we could hook it back to your initial theme that you've brought to this conference about the world being out of balance, Kiyone Kwatsi, I'm not sure if I said that right. Are we going to see more greater balance into the midpoint next year, perhaps?
Well,
depends on who's doing what there, I suppose.
I'm not sure if a recession is really going to rebalance markets. Yeah, and I think that, Adam, what I just am a little bit concerned about is this permanent interventionism that we're seeing. Yeah, and I think that's what I said yesterday at the podium discussion. Actually, I think we should perhaps focus less on what central banks are doing and focus more on what governments do on the fiscal side. I think that 2020 was really the year when fiscal policy took over. I know a couple of politicians, and there's one thing that they really hate. They hate giving up power. And I think they very much enjoy the fact that all those stimulus checks in 2020 it actually worked. Yeah, and of course we're having debt problems now, but we're gonna deal with them later on. So, so I think fiscal stimulus will be much more important in the next recession, and if we compare it to monetary stimulus, obviously it has a faster and more direct impact on the economy and also in inflation. So perhaps the next recession will be a little bit more shallow than previous ones. But on the other hand, it's called an economic cycle. So actually, a recession, I mean, it's not fun, but it's necessary for the next uptick in the cycle. Yeah. So the longer we try to avoid a big kind of cleansing recession, yeah, the more trouble is basically ahead down the road.
Yep. That makes sense to me. Excellent. Well, Ronnie, thank you so much.
Thank you very much, Adam.
Snapshot and talking about Incrementum. Thanks for talking about Assay TV.
Thanks.